Um, Imagine for a second that you are sitting at the primary desk of, like, an institutional allocator.
Right.
The room is totally quiet, but the screens in front of you are just, I mean, they're absolutely blinding. Over on your left, you've got a live trading terminal, and it is just glowing green.
Oh, yeah. Pure momentum.
Exactly. We were talking about historic face-melting bull run numbers. Palantir is up like over 1,655%. NVIDIA is up over 267%.
Wow.
Yeah, it's crazy. And looking at that screen, it feels like the most euphoric, indestructible market imaginable. But then on your right, you have a totally different kind of document.
Right. It's a synthesis report. And, a highly unusual one at that.
Totally. It's a highly detailed, allocator-grade, macro-financial dashboard synthesis. And what makes this stack of research so unique is that it isn't just, one analyst's opinion.
No, not at all.
This document actually cross-references the raw, unfiltered outputs from every major AI model currently operating. We're talking Claude, Grok, Perplexity, DeepSeek, Gemini, and Copilot.
All of them working together.
All of them. And what happens when you force all those models to basically reconcile the structural data beneath those massive tech games?
Well, what's fascinating here is the one-sentence synthesis that emerges from all that data. The AI consensus is that we are absolutely not in a pure bull phase.
Wait, really?
Yeah. The market is currently operating in what they call a risk-on but fragile regime.
Okay, let's unpack this. Because when I look at this trading terminal screenshot, my brain just says, well, tech is king, The economy is booming. Everything is fine.
Sure, that's what it looks like on the surface.
Right. So how can a market that is ripping upward so aggressively also be fragile?
I mean, it sounds like a paradox, but it's actually a very specific mechanical state. The models define this environment as carry-driven, gamma-reinforced, and liquidity-supported.
That's a lot of hyphenated finance jargon.
It is, yeah. But basically it means the foundation underneath those soaring stock prices isn't built on broad economic growth or, fundamental strength.
Okay, so what is it built on?
It's highly engineered, it's completely dependent on specific financial plumbing, and therefore it's incredibly vulnerable to a sudden shock.
Which honestly brings us to our mission for today's deep dive. We are going to build high-level situational awareness for strategic resource allocation.
Exactly.
So whether you are figuring out where to park your cash or optimizing what allocators call a GPIQ liquidity pool.
Which is basically just your high-grade cash and short-term equivalents.
Right. Or maybe you're handling an equities portfolio or looking to sell simple options premium like puts and calls. You need to know the actual mechanics driving this market. We're going to discover the market's blind spots.
Yeah.
The known unknowns and the unknown knowns.
Because flying blind right now, just trusting that glowing green terminal, is how allocators get caught entirely off guard when the underlying mechanics actually shift.
So let's start with those mechanics, the plumbing. If this market is liquidity supported, what does the actual cash flow in the financial system look like right now? Like, what is the Tier 1 data telling us?
Well, the consensus across the models points to a really critical distinction. Domestic liquidity is currently supportive, meaning it's keeping the floor from falling out.
Yeah.
But, and this is key, it is not expanding.
Oh.
The hoses just aren't pumping any new capital into the system right now.
Walk me through how we actually measure that, because I want to understand the mechanics.
Sure. We look at a few major buckets. First, the reverse repo balance, or the RRP.
Right.
You can think of the RRP as a massive short-term parking lot. It's where institutions stash their excess cash at the Federal Reserve overnight in exchange for a little bit of yield.
Okay.
And for a long time, that lot was completely stuffed with trillions of dollars. It acted as this giant buffer for the financial system. If the market needed cash, it could just draw down from the RRP.
And what is that balance looking like right now, like today?
It's sitting near zero.
Wow.
Yeah, the buffer is gone. That massive liquidity sponge has essentially been wrung completely dry.
Jeez. And then there's the Treasury General Account, the TGA. That's essentially the checking account for the U.S. government, right?
Correct. And right now, the TGA balance is highly elevated.
Okay, let's mechanically explain why that matters to you, the investor. Why does the government having a lot of cash in its checking account affect the stock market at all?
Well, think about the life cycle of a dollar. When you, or a massive corporation pays taxes or buys a newly issued treasury bond, that dollar leaves your commercial bank.
Like JP Morgan, or Bank of America.
Exactly. And it gets deposited into the TGA at the Federal Reserve. So that dollar has officially left the commercial banking system.
Oh, I see.
Yeah. It can no longer be lent out. It can't be used to buy equities. It can't be used as collateral. So when the TGA is elevated, the government is essentially hoarding cash that would otherwise be sloshing around the financial markets.
Meaning it causes a mild liquidity drain. So you combine a drained reverse repo buffer with an elevated Treasury General account that's actively pulling money out of the system. What does that do to overall Fed net liquidity?
It leaves it flat. Or, well, slightly down. Now, I do want to be clear here. The system isn't currently breaking. We know this because of something called the SOFR-IORB spread.
Okay, before we go any further, please translate that alphabet soup. For those of us not staring at a Bloomberg terminal all day, what does that spread actually measure?
Fair enough. So SOFR is the secured overnight financing rate. It's basically what it costs banks to borrow cash overnight.
Got it.
And IORB is the interest on reserve balances, which is what the Fed pays banks to keep cash at the Fed. When the spread between those two numbers is stable, it means banks are perfectly happy lending to each other.
Okay.
Nobody is hoarding cash out of fear. So the plumbing is stable, there is no panic.
I'm trying to picture this. It's like if the market is a massive swimming pool, the dam isn't breaking. The water level is just high enough to keep all the boats floating. But the hoses feeding the pool have been completely shut off. There's no new water flowing in.
That is a brilliant way to visualize it. The domestic water level is static.
But wait, that creates a massive logical problem. If domestic liquidity is totally flat, where on earth is the buying power coming from? I mean, Palantir and NVIDIA don't jump hundreds of % on static water. Someone, somewhere, is aggressively pouring fuel on this fire. So what is the fuel?
The Japanese yen.
The currency.
Yes, specifically the Japanese yen carry trade. That is the hidden engine driving this entire mega-cap tech rally. Right now, the USD-JPY exchange rate is highly elevated, hovering around like the 157 to 159 level.
Right.
And that tells the AI models that the carry trade is hyperactive right now.
Okay, look, the term carry trade gets thrown around constantly on financial television.
Yeah.
But the mechanics are what actually matter here for your portfolio.
Yeah.
Walk us through exactly how a weak Japanese currency physically translates to someone buying shares of U.S. tech companies.
The mechanics are beautifully simple but deeply structural. Historically, the Bank of Japan has kept their interest rates pinned at or near zero.
Right.
So if you are a massive global hedge fund, why would you borrow US dollars at 5% when you can go to Japan and borrow billions of yen for practically nothing?
You borrow cheap?
You borrow incredibly cheap, but you don't want to actually hold yen because the yen is depreciating.
Oh, so you swap it.
Exactly. You immediately take that borrowed yen, you sell it, and you buy US dollars. Now you have a mountain of US dollars that costs you almost nothing to borrow. What do you do with it?
You deploy it into highly liquid, high-momentum assets that are appreciating rapidly. You buy NVIDIA.
You buy NVIDIA, you buy Palantir, you harvest the massive gains on those US tech stocks, and eventually, you just use a tiny fraction of those massive profits to pay back your practically free loan in Japan.
It's the ultimate arbitrage.
It really is. It provides massive artificial buying pressure for U.S. equities.
That sounds like an infinite money glitch. Borrow for free, buy tech, get rich. But this actually brings us to our first massive blind spot, our known unknown. The models highlighted a major risk here, specifically a divergence spotted by DeepSeek.
Yeah, DeepSeek flagged an alternate underlying scenario. It saw structural data suggesting the USD-JPY was at real risk of a violent unwind down to the 144 to 145 level.
Meaning the yen would suddenly get much stronger. If you're that hedge fund we just talked about and the yen suddenly spikes in value, what happens?
You get a margin call from hell. Suddenly, the currency you owe your debt in is dramatically more expensive. So to pay back that loan before it bankrupts you, you have to urgently sell your assets.
You are forced to dump your U.S. tech stocks.
Exactly. Now, the unified consensus of the AI models did correct DeepSeek's outlier prediction for now. The yen is currently still weak, and the carry trade is still actively pushing stocks up.
Okay.
But, and this is the critical known unknown, the volatility in the Japanese yen is rising, the foundation is shaking. It makes the yen a latent shock source that could, honestly, cascade into the U.S. stock market at any moment.
I'm having a hard time squaring this, though. You're telling me we are in a highly fragile state, dependent on this precarious foreign currency trade, with absolutely zero domestic liquidity buffer. But when I look at how investors are actually behaving, they seem completely oblivious.
Hold
I
on.
mean, look at the VIX,
Mhm.
standard fear gauge. It's crushed. It's hovering between 12 and 16. People are asleep at the wheel.
They really are. And the MOVE index, which measures rate uncertainty in the bond market, that's also just drifting lower.
And more importantly, look at the credit markets. I mean, I've always been taught that credit investors are the smartest guys in the room. They don't buy into equity hype. They just care about getting paid back.
Right.
But right now, high-yield option-adjusted spreads, HYOAS, they're sitting at roughly 270 to 310 basis points. That is a cycle low. They are demanding virtually no premium to take on junk bond risk. Credit is screaming, no recession, no defaults, everything is perfect.
Yep.
So why shouldn't I just trust the credit markets over these AI models?
Well, if we connect this to the bigger picture, we start to see where the headline numbers are actually lying to us.
Oh, interesting.
The AI models cross-tabulated all that euphoric leading indicator data, and they found three massive glaring contradictions beneath the surface.
Okay.
These are our unknown knowns. Things happening in broad daylight that the headline metrics, like the VIX, are completely masking.
Okay, let's go through them. What is the first contradiction?
Stealth hedging. While the VIX is incredibly low, the skew index is highly elevated.
Stop there. Explain the mechanical difference between the VIX and skew, because I feel like that is vital to understand.
Okay, think of the VIX like the price of standard homeowners insurance. Right now, it's sunny outside, no one expects a kitchen fire today, so standard insurance is dirt cheap. Retail traders and algorithms are happily buying the daily dip.
Makes sense.
The skew index measures something entirely different. Skew tracks the institutional demand for extreme, deep, out-of-the-money put options. It basically measures the demand for catastrophic earthquake insurance.
Ah. So the headline, VIX looks calm because day-to-day trading is quiet. But an elevated skew means that behind the scenes, massive institutional players are quietly, steadily pouring money into insurance against a total systemic collapse.
Exactly. They are hedging their bets without triggering the headline fear numbers.
Wow, it's the definition of stealth hedging. An extremely sophisticated warning sign that the smart money does not trust the foundation of this rally.
It gives you chills, doesn't it?
It really does.
Yeah.
Okay, what is the second anomaly?
The gold and DXY divergence. Historically, gold and the US dollar index at DXY, they operate like a seesaw. They move in opposite directions. If the dollar is strong, gold struggles.
Right.
But right now, the DXY is flat to slightly down and gold is surging. It's incredibly strong.
Why does breaking that correlation matter?
Because gold isn't just a shiny metal. It is the ultimate sovereign safe haven asset. When gold aggressively breaks its correlation with the dollar and starts climbing on its own, it means the oldest, most cautious capital in the world is sniffing out a macro tail risk.
Like what kind of risk?
They're pricing in sovereign debt issues, geopolitical shocks, or a currency crisis. Gold is reacting to a risk that the equity and credit markets are completely ignoring.
Which brings us to the third contradiction. And I think this one ties the entire plumbing and carry trade argument together. Inconsistent breadth.
Right. You look at the S&P 500, the ES futures, and they are just grinding higher day after day. But if you lift up the hood and look at the engine, the advanced decline line, the ADD, and the NYSE tick are completely mixed.
Let's define those for everyone. What are ADD and tick actually measuring?
The advanced decline line simply measures how many individual stocks went up today versus how many went down. The NYSE tick measures the number of stocks making an uptick in price minus those making a downtick at any given second.
So they measure the internal participation of the market.
Exactly. When you have a healthy bull market, everything is rising together. Broad participation.
But right now, they are mixed, meaning the index is going up, but the average stock isn't.
Precisely. Small caps are actively lagging. The broader market is struggling just to tread water.
Which perfectly matches that live trading terminal from our intro. We do not have a broad, healthy bull market. We have a narrow leadership market heavily concentrated in mega cap tech and AI.
Yeah.
The market isn't rising. NVIDIA and Palantir are rising, and they are so massive they are just dragging the entire index up with them.
So put those three unknown knowns together. Institutions are quietly buying catastrophic earthquake insurance. Gold is pricing in a systemic macro shock. And beneath the index level, only a tiny handful of tech stocks are actually holding the market up.
Risk on, but fragile.
Exactly.
So how do you actually use this information? I mean, if you are managing assets and you know the market is grinding upward on narrow tech leadership, fueled by a fragile Japanese yen carry trade, while institutions are stealthily hedging, How should you strategically allocate your resources?
Well, this is where the AI models provided specific allocator-grade implications. Let's look at your GPIQ liquidity pool.
Okay.
If you are managing institutional cash or even just your own personal cash reserves, operating in a fragile risk-on regime demands very strict discipline.
So if I'm looking at my cash reserves right now, what is the play?
First and foremost, you must maintain surplus liquidity. We established earlier that the reverse repo buffer is empty, the domestic liquidity sponge is gone. That means when a shock hits like that yen carry trade unwinding, the volatility will be violent because there is no cash buffer in the system to absorb the selling.
Oh, I see.
You need surplus cash on hand so you aren't forced to liquidate assets into a crash. And so you have dry powder to deploy when things violently misprice.
So we are holding extra cash. Does that mean we stop buying equities altogether?
No, but you only engage in selective dip buying. Because breadth is so incredibly poor, you cannot blindly throw money at a broad index fund and assume a rising tide lifts all boats. There is no rising tide.
And I assume leverage is completely off the table.
Leverage is institutional suicide in a fragile regime.
Yeah.
The market is already highly leveraged through the Japanese carry trade and derivatives. Adding your own leverage to a fragile system is just begging to be wiped out during a sudden repricing event.
What about different sectors? The models specifically highlighted avoiding small caps. Why? Because they seem historically cheap compared to tech right now.
They are cheap for a reason. Mechanically, small cap companies survive on cheap domestic floating rate debt.
Okay.
They need a booming domestic economy and easy borrowing conditions to thrive. As we discussed, the TGA is elevated, the ROP is empty, and domestic liquidity is tight. Small caps simply do not have the oxygen they need to run in this specific environment.
Which leaves us with the heavy hitters. The models actually favor holding mega cap tech and AI infrastructure.
Which perfectly validates those massive NVIDIA and Palantir positions we saw on the terminal.
Right.
It seems counterintuitive to buy the most expensive stocks in a fragile market, but mechanically it makes sense. In a fragile regime, capital flees to the perceived safest, most liquid, highest momentum assets. Right now, that is AI infrastructure. You can ride the wave, but you have to recognize you're riding a very specific narrow current.
Now, here's where it gets really interesting, though. A lot of sophisticated investors look at a market that is slowly grinding sideways or creeping upward, and they think, hey, this is a low volatility environment. This is the perfect time to sell simple options premium.
Oh, yeah.
They want to write cash-secured puts to collect income or sell covered calls. How does this synthesis apply to the options market?
This raises an incredibly important question, and it comes with a severe warning from the models. Selling premium right now is incredibly dangerous because the synthesis identified this market as gamma reinforced.
Okay, gamma is one of those terms that scares people off. Let's break it down. Explain the actual mechanism of a gamma reinforced market.
Sure. Think about the market makers, the massive financial institutions that actually sell you those call options on NVIDIA.
Okay.
When retail traders and hedge funds buy millions of call options, the market maker takes the other side of that trade. But market makers don't want to gamble. They want to stay neutral.
Right, they just want to collect the fees.
Exactly. So to hedge their risk of NVIDIA going up, the market maker is forced to go into the open market and buy actual shares of NVIDIA's stock.
Wait, so me buying a call option literally forces the dealer to buy the underlying stock?
Yes. And here is where the gamma feedback loop really kicks in. As the stock price rises, the option gets closer to being in the money.
Okay.
The math changes, and the market maker is forced to buy even more stock to stay hedged. Their forced buying pushes the stock price even higher, which draws in more retail traders to buy more calls, which forces the market maker to buy even more stock.
So the tail is completely wagging the dog. The derivatives market is dictating the price of the actual stock.
Exactly. Fundamental investing takes a backseat. You are operating in a market heavily dominated by momentum and derivatives flows.
So if you are an individual investor selling options premium, say, selling puts in this environment, you're taking on immense asymmetric risk. Let's drop the old finance cliches for a second. Selling premium right now is like writing earthquake insurance policies on a town where you know every single house is secretly built on an active fault line.
Wow.
You collect small, steady premiums every day, the earth doesn't shake. But remember, our unknown known SKQW is elevated. Institutions are bracing for a massive tail event. The carry trade is fragile. Right.
If a sudden shock hits, say, the Bank of Japan raises rates, the yen spikes, and the carry trade unwinds, the margin calls hit, that gamma feedback loop we just talked about, it instantly reverses.
Oh, man.
Dealers are forced to aggressively short the market as it falls, the repricing of volatility will be violent, and anyone holding short premium positions will face catastrophic losses.
So what does this all mean for you? If you are managing your portfolio, holding your cash buffer, riding the mega cap tech wave, but trying to avoid the earthquake, how do you know when this fragile balance is finally breaking?
Well, true situational awareness means you don't wait for the headline news to tell you to panic. You watch the exact structural data tripwires that these AI models have identified. You need to sound your own internal alarm if you see any of these four things happen.
Okay, tripwire number 1, the high-yield OAS.
Right. Right now, credit spreads are at 270 basis points. If you see that spread widen past 330 basis points, it means the illusion of safety in the credit market has broken. The smart money in bonds is pricing in real distress.
Got it. Tripwire number 2, the Japanese yen.
The primary fuel source. If the US DJPY crosses the 160 threshold, or conversely, if it violently drops, signaling a massive carry trade unwind, that's a huge red flag. Keep your eyes on the yen. If the fuel stops flowing, the tech rally stalls.
Tripwire number 3, the movie index.
If rate uncertainty spikes and the movie index crosses above 110, the bond market is panicking. And historically, where the bond market goes, the equity market eventually follows.
And finally, tripwire 4, breadth and divergence.
If you see the S&P 500 grinding to new all-time highs, but the ADD and tech show even fewer individual stocks participating, or if gold continues to aggressively surge while the US dollar remains flat, those are your final warnings that the structural cracks underneath the surface are widening.
Wow. Okay, to summarize this entire deep dive, we are currently surfing a historic, highly engineered wave. It is a wave powered by borrowed Japanese yen, gamma-driven derivatives loops, and just enough static domestic liquidity to keep the music playing.
Yeah, that's it in a nutshell.
You can navigate this right by maintaining surplus cash and focusing on highly liquid mega-cap tech. But you cannot afford to be complacent, because beneath the surface of that glowing green terminal, the smartest money in the room is looking at the plumbing. And they're stealthily buying insurance against a fundamentally fragile foundation.
Exactly. It is a market that will continue to grind higher, looking perfectly healthy, right up until the exact second it doesn't.
Which leaves us with one final lingering question to ponder as you look at your own asset allocation today. If massive institutions are quietly loading up on SKU to buy catastrophic earthquake insurance against a crash, while simultaneously using heavily borrowed Japanese yen to push U.S. mega-cap tech into the stratosphere, what happens to those euphoric AI positions when that carry trade finally snaps and everyone rushes for the exit at the exact same time?
That is when you find out who is swimming naked.
Keep your eyes on the plumbing.